Basic Appraisal Principles, page 360, Unit 4, Real Estate Contracts and Financing. High interest rates and loan fees on construction financing, and they supervise the progress of the construction. There is always a danger that the borrower will overspend on a construction project and exhaust the loan funds before construction is completed. If the borrower cannot afford to finish, the lender is left with a security interest in a partially completed project. Lenders have devised various methods for disbursement of construction loan funds that guard against overspending by the borrower. A fixed disbursement plan calls for a series of predetermined disbursements called obligatory advances at various stages of construction. For example, the loan agreement might provide that the lender will release 10% of the loan funds when the project is 20% complete, and another 20% of the funds whenever construction has progressed, another 20% toward completion. Alternatively, the lender might use the voucher system, requiring the contractor, who's the borrower, to pay the bills and then submit the receipts to the lender for reimbursement, or the warrant system, in which the contractor presents the bills to the lender for direct payment to the subcontractors, laborers, and materials suppliers. Wraparound mortgages. Wraparound mortgages are most often used in seller-financed transactions. The buyer takes title subject to, but does not assume the seller's existing mortgage. The seller accepts a down payment and a purchase money mortgage from the buyer. Although this new mortgage is junior to the seller's existing mortgage, it is for a larger amount than the existing mortgage balance. Thus, it includes or wraps around the existing mortgage balance. The new mortgage is the wraparound mortgage, and the seller's existing mortgage is called the underlying loan. The buyer makes payments to the seller on the wraparound, and the seller continues to make the payments on the underlying loan. For example, a home is being sold for $100,000. There is an existing $40,000 mortgage against the property. Instead of assuming that mortgage, the buyer merely takes title subject to it. The buyer gives the seller a $20,000 down payment and a second mortgage for the remaining $80,000 of the purchase price. The $80,000 second mortgage is a wraparound mortgage. Each month, the buyer makes a payment on the wraparound to the seller, and the seller uses part of that payment to make the monthly payment on the underlying $40,000 mortgage. Depending on the circumstances, a wraparound mortgage can provide the buyer with financing at a below market rate while giving the seller an excellent return on the investment. However, A wraparound financing works only if the underlying loan does not contain a due on sale clause. Otherwise, the lender would require the seller to pay off the underlying loan when the property is sold. Government programs. So far, we've discussed conventional loans, institutional loans that are not insured or guaranteed by a government agency. Now we'll look at loans that do not have government backing, focusing on the main home financing programs offered by page 361. The federal government. These programs were established to encourage residential lending and make housing more affordable. Federal Housing Administration, FHA. The FHA was created by Congress in 1934 as part of the National Housing Act. The purpose of the act and of the FHA was to generate new jobs through increased construction activity, to exert a stabilizing influence on the mortgage market, and to promote the financing, repair, improvement, and sale of real estate nationwide. Today, the FHA is part of the Department of Housing and Urban Development, HUD. Its primary function is to insure home mortgage loans. The FHA compensates lenders who make loans through its programs for losses that result from borrower default. The FHA does not build homes or make loans. In effect, the FHA is a giant federal insurance agency. Its insurance program, known as the Mutual Mortgage Insurance Plan, is funded by premiums paid by FHA borrowers. Under the plan, lenders who have been approved by the FHA to make insured loans either submit applications from prospective borrowers to the local FHA office for approval, or if authorized by the FHA to do so, perform the underwriting functions, review of the appraisal, mortgage credit examination, etc. Lenders authorized by the FHA to fully underwrite their own FHA loan applications are called direct endorsers. Note that prospective borrowers apply to an FHA-approved lender, not to the FHA. As the insurer, the FHA is liable to the lender for the full amount of any losses resulting from default and foreclosure. In exchange for insuring the loan, the FHA regulates many of its terms and conditions. The lender must comply with FHA regulations, which have the force and effect of law. These regulations and FHA procedures have influenced the real estate lending industry as a whole. FHA programs are generally open to all borrowers who intend to occupy the property being financed. The property ordinarily must be the borrower's principal residence. FHA loans have a number of features that distinguish them from conventional loans. The most significant differences are outlined below. Upfront and annual mortgage insurance premiums, MIP, MIP. The feature that distinguishes FHA mortgages from conventional and VA mortgages is the payment of mortgage insurance premiums, MIP. Regardless of the size of the borrower's down payment, mortgage insurance is required on all FHA loans. For most FHA programs, the borrower is required to pay a one-time upfront premium plus annual premiums. The upfront premium may be paid in cash at closing or financed over the term of the loan. The additional annual premium is paid monthly, along with the principal, interest, taxes, and homeowners insurance. Cancellation and refund of MIP. Currently, borrowers paying off or refinancing their FHA loans within 5 years from the date of closing are entitled to a partial refund of the upfront premium. Borrowers are advised to ask their lender about a potential refund before paying off an FHA loan. In the past, some FHA borrowers have paid annual mortgage insurance premiums throughout the life of their mortgages, effective for all loans closed on or after. End of page. Extra notes. Amount real estate checkup utilize. I don't know what they're talking to, what that was about. Something about 80% they take it off, and it's pointing towards the FHA.